Just let's be practical a bit. All right, so ISS 7 is talking about provisions, contingent liabilities, and contingent assets. When you hear the word provisions, what comes to your mind, Mr. Omoife? What comes to your mind when you hear the word provisions and contingent liability? Okay, thank you very much. Okay, that's fine. So, according to IS 37, provision is defined. It says to, as a system ensures that provision and contingent items are accounted for consistently and disclosed transparently. So, what do we define as provisions? According to IS 37, a provision is a liability of a certain timing or amount. So, what would make something be called a provision? It must have those quality. One, there must be an uncertain timing. When you make provision, for example, now you are traveling to Abuja from Lagos, and bus last week was 15,000 naira, and your uncle that went said that, my brother, I paid 18,000 naira, and one of your brother again said, my brother, bus don't become 12,000 naira. So as you're now going, you're like, you normally, because you have had first hand experience, you paid 15,000, but now you are getting two people saying that, oh, this bus is 18,000 and the other says 12,000. What would you do? You will do what? You will now take like 15,000, which you paid before, and now add extra even 5,000 pounds naira, saying we never can tell you, I can get there now, the bus becomes 20,000. I will never can tell, I can get there, the bus even becomes 12,000. Do you get? So that 5,000 you've held on as extra is called provision. Does that make sense? So that is provision. But however, now, in line with IS 37, the provision you are making now can be in different form. So provision in IS 37 is always a liability of uncertain timing. Now, what I've explained to you is amount and not a liability, but something that you need to that need to happen, which is more like contingent. Now, if I'm to explain a liability of a certain timing, for example, now, I'll use the common one that I used to face regularly, is if a staff sues a company, or a company is sued by an entity or anybody. When the company calls their lawyer to put everything to their lawyer, they will discuss it with their lawyer. And then the lawyer will look at the case critically. The lawyer will assess everything in the case and say, from the look of things, the lawyer will bring up so many things. Oh, let me go into one of them, which is that now the lawyer will look at things like, do they have statutes of limitation? For example, in the UK, statutes of limitation is, I think, 6 years before any case can be thrown out. I have a client like that, that they had a case with another big company, and those companies are very rich to drag them. So they now have what is called statutes of limitation. So now they now look at it like, okay, this case has been going for 5 years and we've never even been to the court for one day, because they've never taken us to court. They've just been threatening us. They sent us letters before. They threatened us for 2 years, and we thought that they said the liability that we incur, we owe them, is, let's say, £1 million. But because we have assessed this, we've brought the professional experts that have said what this thing is, what this liability should be, is 800,000, not 1 million. So therefore, we think our liability might be 800,000 for this thing. So now, do you think you're likely to pay that liability? Mm, yes or no? The lawyer will tell you that from the look of things, you're likely to pay this liability. At year two, the lawyer thinks you're likely to pay this liability. Okay, when are we paying? We don't even know, because we've not even gone to court yet. So that liability that the lawyer has told you about, the percentage of assurance, which is more likely, more probable to be paid, then it means an obligation exists with you, with the third party, and then you need to make what's called provision in your account, and that money you set aside is called provision. I don't know if that makes sense. So when it comes to year three, we have to assess it every year until that case ends. He said that, oh, we are still likely to pay this amount, then it becomes there in the account. Then year four, we're likely to still pay. Then year five, lawyer says, I don't think we might pay, because we've not even been to court for this, and from the look of things, I don't even know. I think I'm 50% sure that we might not pay. It is 50% sure we might not pay, but which means the remaining 50% means we might pay. I mean, that's what do you think the answer will be for year four? Sandra, what do you think the answer will be? I know why I'm calling both because you're chartered accountants. Sandra, what do you think the answer will be? The third year, the liability was still there. They said that, oh, that has to be, that they are the like there are things that they are likely to still pay. But in the fourth year, the lawyer said that he is 50% sure that they will not pay, but which means 50% is still sure that they might pay. So what should happen to the provision? Why? Why? Okay, thank you very much. Okay, so you are correct. So, but however, the lawyer cannot say it should be 100%. She cannot be 100% sure, especially when a case is ongoing. A lawyer can only give a percentage of probability. So, a lawyer saying that is 50% sure that the case might not go on means he has exposed the company to 50% on assurance that the case will go on, which means, according to IAS 37, a 50% probability be provision. If you remember your standard, when the case is 50% probability, then this provision should still exist. Only when it becomes 49%, then you can take off the provision from your account. So, which means at this stage, provision will still remain there based on that example. Then when we now get to the 60th, let's say, oh, I think provision might not exist because I can be like, I think I'm 80% sure the original will not exist because why? Statute of limitation in the UK is 6 years, and this is the 60th year. They haven't raised any case. I think they will have lost their chance of raising any case against us. So therefore, we think this position might not exist. At that stage, we will only do what we only disclose. We will do what we will disclose in the notes to the financial statement that so and so exist though. But however, blah 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 blah. So I'm going to give an example. Let me pause this now. Let me. Hmm? So exactly. So that thing is an obligation that they have. So Temu, Amazon is obligation. They have 30 days to what to refund that thing back to them. So within that 30 days, they will keep that money separately. They won't touch that money. In fact, they will not pay the vendor that money. Because then at the moment they pay the money to the vendors, then of course you can easily say the vendor will say that no, I can't return it back. But they will keep the money and then after 30 days, they will not pay the money to the vendors, knowing that you have not refunded, you have not returned those items back. So it is what it is an obligation that the company has with what with you. So I move to the next thing. Now I want to distinguish between what provisions and other liability. So now trade payable, I've give items certainty timing an example. So payables are what they are certain because why? They are people you are owing, they are invoice for them, right? Hmm? So they are certain. The timing is certain also because there are invoices received for goods purchased, right? Across is what is certain, but however, the timing is uncertain. Am I correct by saying the timing is uncertain? I taught you across yesterday. I said what? Across is different between across and trade payable is what? What did I say it is? Difference between across and trade payable is what? Who can tell me? I taught you guys this in 2 days ago. You said it, but you said it wrongly. So a trade payable is services enjoyed with invoice received from supplier, not customer. Don't use the word customer. Customer is for debtors. While across is services enjoyed, but invoice has not been received. That is why it is called timing is uncertain. Can you see? Because why? You don't know when you're going to pay. Okay? Because across, you've not gotten invoices from them. So without invoice, you cannot pay. You can see that's why the timing is uncertain. So utilities owed but not yet billed. Can you see it? That bill is the invoice we're talking about. That is accrual. So what is provision? Provision is what certainty is uncertain. You are not even sure you are going to pay, but we're just trying to be prudent, like IFRS want us to be. So in terms of being prudent, we need to what to raise what a provision. Then the amount and or time is also uncertain because it might be 2 years we are going to court, dragging, you know, we might be 2 years, 3 years, we might not be sure about it. So warrant examples are warranty claim, restructuring costs, etc. So measurement of provisions. Now, the principle is that the amount recognized should be the best estimate of the expenditure, like I did said, required to settle the parent obligation at reporting date. So, like I did said, like when you have a lawyer, you speak to your lawyer, you try to do best estimate. If the amount is 1 million, they're claiming. Some people can be unreasonable, charging you 1 million, 1 million naira or £1 million, whereas it's just 800,000. So you bring an expert. An expert will then come and say, "Oh, this one I'm looking at is just 800,000 naira and not 1 million naira." So because expert has said it is 800,000, you have to go for the expert because you will not pay 1 million because what that person is charging you is unreasonable. They are saying it's 1 million because anybody can call any amount. Anybody can call 5 million, 10 million, 50 million. But what does an expert say? An expert said that it's going to be 800,000 naira. So therefore, you should make a provision for what 800,000, which is your best estimate, because you don't want to overstate your account and you don't want to understate your account. So how do you determine this? Like I said, management judgment and expertise and experience. Can you see based on handling this? Maybe in previous years they've handled such things. Then when they handled it, they realized that oh, it was just 800,000 we paid. Also historical evidence, like you can go and look for invoices of similar things. Go online, go and check online similar past events just to be sure of the of how to of the figures that is required. Also allowance for uncertainty. If many similar items use expected value, like weighted probability approach, you can use expected value approach to say, okay, what am I supposed to pay on this? If it is this, if I've left this, I've spent 3 months before, I paid 60,000 in 3 months, then I've used 1 year, which was 3 months times four. That's 60 times four. That is 240,000. And I know that okay, I should be paying expected value should be about 240,000. Something like that, using like some kind of forecasting. Then you can also use discounting. If the time value of money is material, discount to present value. You can discount to the present value from future value. Let's say you've not there's a provision to pay when you are leaving the site at the end of 1 year or at the end of 2 years, but you know that the amount to be paid if you are leaving is maybe 1 million naira. You can do PV to today to know what the value of that money is today, and the value of that money might be 800,000 in today's value. You know how to do PV. I taught you how to do PV in previous class when we were doing lease. So you do the lease like that using PV, which is like PV is what the value of the amount, which is 1 million naira, bracket one minus bracket one plus arrow. Arrow is the rate of what? The rate of what? Of lending rate, which is the discount rate. Then bracket close raised to power minus n, which is number of years, right? Bracket close divided by what? Divided by what? Divided by what? The um divided by discount rate. That is your this thing. That is your present value calculation. So you can use discounting to get the present value of the value. So that's it. So I want to ask you a question now on this based on what I've taught. But sorry, did you guys follow me so far up to this point? Mr. Opele, Miss Sandra, do you follow? Have you followed me? Joke, do you follow me? Okay. Sandra, are you okay? Or do you have any question you want to ask me on that? Okay, I want to ask a question. So, warranty provision, Grace Motors Limited sells, because no matter how much I tell you stories, if I don't give you practical solution and practical examples, you will not still know it. So, Grace Motors sells 1,000 cars in 2025. Each car has a 1 year warranty. Based on past experience, can you see? Based on past experience, 5% of cars will require repairs. Average cost per repair is £400. Calculate the provision at year end. Who can help me do that, please? Grace Motor sells 1,000 cars in 2025. Sandra, do you want to try? Samuel, do you want to try? Samuel, do you want to try? Each car has a 1 year warranty. Based on past experience, 5% of cars bill require repairs. Average cost per repair is £400. It's on the screen, sir. 5% of cars will require repairs. Average cost per repair is £400 for each repair. So they sell 1,000 cars in 2025. So if 5% of the cars will require repair, which is what? Which means that 5% will not require exactly 50 times 400 to give you what? 20,000. Okay. So let's look at the answer. Provision equals 1,000 times 5%. Can you see? So that's 20,000 is what you're going to watch. You're going to put as provision in. What you do? Debit P&L expense for provision, then you credit for provision's liability. Simple as that. Then you put in your notes to disclosure on what you are providing for. Shikena. Question 2, Adejoke, this is for you. So, oh yeah, can you read please and answer the question? Adejoke, I'm waiting for you. Hello? Okay, since she's not there, let me kick her out then. I'll only give people who are here alone. So, all right. Okay, so Mr. Moife, can you answer this question for me, please? Yes. An oil company must dismantle an oil rig in 5 years. Estimated cost equals £10 million. Discount rate equals 8%. An oil company must dismantle an oil rig in 5 years. Estimated cost equals £10 million. Discount rate equals 8%. I'll be punching on my phone to get the answer. Hmm. It's on the screen. That's the question. Let's check the answer. What we want you to do is do PV. Simply, you're doing the present value of that figure today to know what you put in provision. What you are doing is the PV, present value today, which is 1.08 raised to power 5. 10 million divided by 1.0, which is the PV of it. We get 6 million today. So you record 6.81 million as a provision in your account. So, and capitalize as part of asset cost. Because why? That is a major figure, is a major amount which will affect your profits, right? So you have to capitalize that figure because it's an oil rig. And that oil rig is part of what you use to do your transaction every day. You can't just go and say debit expense and credit provisions. It will not work that way. Do you get? Because you cannot go and capitalize you cannot go and put 6 million in your expense, say debit expense like this now. You can't say you can't say debit expense, credit provision liability. You can't do that on this because it is an oil rig. So what you need to do is what? You will do what? You will debit you will debit what? An asset. You debit your asset account and then you credit what? You credit provision for 6.8 million. Then you know it's a discount factor. You've done discount factor already. You've discounted it already. So then you will then be doing what? You'll be reducing it every year by doing what? Every year you'll be doing what? Credit what? In 5 years. So you have what? 6.8. Just like how we did lease. You know how I showed you lease now? How I showed you lease. It's the same way we're going to do it. Like you're doing lease, how you're going to do it. divided by 5, 1.361. So then the interest you'll be paying on it, which is 10 million times 8% of it. So you just do the posting and then you are good. Is that clear? Or do you want me to go over it? Is that all right? Hmm? Is that clear? Or is it not clear? Hmm? Okay. All right. So common example of provision. So warranties are what? They are provision because what? Warranty is a probability that claim will exist. For example, who can give me example of warranty? Who can give me example of warranty? Exactly, Amazon. Exactly, Amazon is warranty because you can decide to use that exercise machine you bought for 9 days and return it back on the 29th day, and then go and buy a new exercise machine again and use for another 29th day again and return it back again on 29th day. And Amazon will not block you for doing that. They'll keep supplying you and they'll keep taking it back. It's just the policy. So that's what happens when you're in a good country. So another thing is major repairs. So you gradually accrue cost for a repair. Is that a provision? No, because repair you cannot provide for repair because you don't know if your item is going to spoil or not. So what do you do? You do what? You depreciate, isn't it? Hmm? And as you depreciate, when the repair occurs, if the repair is a large repair, what do? You capitalize it. According to IAS 16, I'm sure you've done PPE. Mr. Badru taught you, right? If there are IT, if for example, you want to repair a plane, a part of a plane, it's going to be very expensive. It might cost you maybe um $20,000 or let's say $200,000 to repair a part of a plane. That cost now has to be what's capitalized as part of the plane cost. You cannot say you want to go and put the repair cost as expense because it's going to be high. However, some repairs, for example, if you want to buy engine or oil filter in your car to repair your car or service your car, which is for the company, you don't capitalize such costs because it's trivial. What do? You expense it. So those are the ways. So anything repair cost, maintenance cost of something, you don't capitalize them and you don't provide for them because they don't qualify to become a provision. So what about environmental damage, like pollution of cleanup, restoration, like dilapidations? Those are constructive and legal obligation. So therefore, you must recognize provision for them. I don't know if all this thing makes sense to you. Let's think about it in real life situation. If you're an oil rig and you have to repair a place. You're always pouring smoke, 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 doing engine oil, everything, engine oil there. You have to restore that company back because you are not the owner of that property. You only rented it for 10 years. So therefore, you need to what? Create a provision to restore that place because what? There's a constructive and there's a legal obligation. Because if you check your contract to be there, saying that you shall return this building back to us the way we've given it to you. Well, failure to do this will make sure so and so happen. So therefore, you need to create what? A provision for that. Also, the commissioning costs, like if you are commissioning something, maybe you got what? You got a tractor, or let me use something like you came to install something, one big machine, you know, in a place on the ground, and you had to drill the ground. You put that machine there to be able to be producing using that machine. And that machine is not even your own. You went to rent that machine, or the machine is on lease. So the moment you've used that machine, you are returning that machine back. You have to decommission. You have to pay some cost for it because what? That ground which you've drilled, you need to what? You need to you need to pay some decommissioning cost because you've removed that in the ground. There's a hole in the ground. You've probably created a big gutter in the company. So you need to what? You need to pay a cost for what? For the decommission because what? There's a legal obligation on that. So also, in line with IS 37, there are disclosures that need to be made on them. So, if the disclosure you need to make is that one, the opening, I've passed, it's 7 o'clock. Okay, give me 10 minutes, I'll be done, please. The opening and closing carrying amounts has to be disclosed. For example, if you're having a provision of, let's say, 50, you have a provision of 50,000 naira last year, and this year, because your lawyer said that, we think the money is more than that because when we did the evaluation, we didn't get it right. But however, we got the evaluation that says that this is the figure that needs to be disclosed, which is supposed to be 80,000 and 50,000. Then this year we'll be adding extra 30,000 on it. right? So therefore, we need to show the movement by disclosing that last year we provided for 50,000. However, we got further information from an expert that made us realize that the provision we made last year has been adjusted due to inflationary costs, and therefore we've increased our what provision to what 80,000, whereby increasing it by 30,000 naira. So those explanation has to go on the note to what to the financial statement. Also, additions, utilizations, and reversals during the year. If you have any reversals you've made, let's say you probably provided for 1 million before, and a lawyer says, "Oh no, we think we are not going to be paying this provision again because from what we can see here, we think we are going to win this case. We are 100% sure we are going to win this case. So therefore, you will reverse the provision. If you provided before 400,000, then you now reverse to zero. You now write in a note that due to so and so, we believe that we are not going to pay this provision, and therefore we have reversed this provision. So you have to explain everything: nature of the obligation, expected timing of the outflow, major certainties and assumptions you used to get that figure you put on the account. I'll give an example of provision which says the company recognized a provision of 6.8 million pounds for such restoration cost. The expedition is expected to occur in 2030. The amount is based on current legal requirements and discounted at 8%. Can you see? That's a provision you've explained. You've explained as a disclosure to explain what you did and how you came to it in a simple English term without any ambiguity, without mentioning IAS 37, without mentioning anything legal and blah 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 in it. So just make it simple your disclosure so that a layman that picks the financial statements can read and understand that account very well. So now I'll move to contingent liabilities and assets. So we have what's called contingent liabilities and contingent assets. So a contingent liability is a possible obligation from past events. Don't worry, I'll give you shortcuts to understand this very easy. From past events confirmed by uncertain future events or a present obligation that is not recognized because one, an outflow of benefit is not probable or the amount cannot be measured reliably. So what do we call probable? Can you see? More than 50%. You see, I mentioned it here. So if you're saying that you are sure that, oh, this case will not go by 50%, then you are telling me that it might likely occur. So therefore, we are going to what recognize provision. If probable, recognize what provision and not a contingent liability. So what do we call contingent liability? A contingent liability is what is a possible obligation. If you hear the word possible in exam, or please, examiner might not tell you contingent liability, might just tell you there is a possible obligation, madam, brother and sister. Know that that is the contingent liability, and then therefore do not recognize provision. That's the shortcut to know it. The moment you hear the word that the lawyer said it is that there's a possible obligation, the moment you hear that word possible obligation, don't recognize liability. Because what? He said from past events confirmed by future blah, 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 but it's uncertainty, a parent obligation that is if that is not recognized because an outflow is not probable. The only time you recognize a liability is when it is probable. So if you're an exam or people that are doing CCA, please, if you hear the word, it is probable, please recognize provision. Even if they tell you it's 49%, recognize provision. The moment you hear the word is probable, recognize provision. They will use that word to distract, to confuse you. If you hear the word it is possible, don't recognize provision, just disclose. Okay? If you hear the word it is possible, don't recognize provision, just disclose. That's a shortcut. If you hear the word it is probable, please recognize provision and disclose. So I don't know if that is clear. If you hear the word possible obligation, don't recognize provision, just disclose. If you hear the word probable, recognize provision and disclose. That's just what it's talking about. Let me move to the next stage. I don't waste time here. Question: a company is being sued for 100,000 pounds. Legal advice says it's only 30% likely to lose. Joke, what is the answer here? A company is being sued for 100,000 pounds. The lawyer said that it is only like 30% likely to lose. What is going to happen here? Are we supposed to recognize provision? Is it probable? Is it possible? Or is it a what is it? Is it a contingent liability or a provision should be required? That is it possible or is it probable? So what should be done? So what should be done? So what should be done? Hmm? What should be done? Hmm? So what they should do is they should disclose it in the account. It is not probable. Contingent liability disclose only. So if probability rise to 70%, then recognize provision. Can you see it? Because it is only 30% likely to lose. So therefore, do not make provision. Only recognize what? A what? Only disclose it. You can see it is now what? A contingent liability. Can you see? Not probable. Therefore, contingent liability. Disclose only. If probability rises, then it is provision. Can you see? Because it is not probable, because it is only possible. Therefore, disclose alone. So that is for contingent liability now. I'll move to contingent asset now. So what is a contingent asset? So therefore, similarly as we have contingent liability, we also have contingent assets. Similarly, as you are owing somebody, someone can be owing you also. In fact, as I'm owing you because I am thinking you might sue me, you at the other end too are expecting money from me. So you are supposed to make provision in your account. So to me, it's a liability to use an asset. Don't get you get to me, it's an asset to you, it might be a liability. So what is a contingent liability? A contingent liability is, sorry, I meant a contingent asset here. So a contingent asset is a possible asset. Not please change that word from asset, liability to asset, please. It's contingent asset I meant. A contingent asset is a possible asset from past events confirmed by future events, not wholly under entity's control. Can you see? Contingent asset is not under your control. Therefore, it is only a possibility that it can happen. For contingent assets, do not ever recognize a contingent asset and do not disclose a contingent asset. The only time you disclose, according to IAS 37, is only when it is probable. For example, now if you are sure your lawyer is saying that Mr. Moefe, you are likely to win this case. We are 70% sure you're going to win this case and you disclose, but you're not to recognize the figure in your account. Okay? Recognize only when you are virtually certain. This virtually certain is something that is almost impossible. When do you become virtually certain? It's when, for example, my lawyer says that I'm going to likely to get 70% of that money back from my people. However, that money already been paid to me as a deposit already in my account. Then I recognize what a receipt for them because I'm virtually certain. But if the money has not entered my account, maybe I've not received deposits before. For example, now for your landlord that gave you your house to rent, that rents house to you, if he says you're going to clean and is sure from what he sees, his lawyer says that Mr. Moif is going to pay me he's going to pay £3,000 for when he leaves your house, and he has that money as deposit in his account. He has it as deposit secured somewhere. Then the lawyer can what? The man can say it is virtually certain, and then he will recognize that figure as his money in his account. Is that clear? Does that make sense, please, everyone? Mr. Upele, are you lost? Or are you here with me? Please just respond, please. Mr. Upele, are you here? Contingent assets. Sorry, come again. Contingent assets. Exactly. The, if it's possible, if it's a possibility. And when is it possible? When is it possible? When is it a possibility? Eh? It is a possibility when it is less than 50%. When your lawyer say that, oh, Mr. Opele, I think you might not win this case, so you might not win this case, so then you are saying that, oh, sorry, then you cannot even disclose it in your account as a contingent asset, right? But a contingent liability, when your lawyer says that, Mr. Opele, you might not win this case, so and it is a contingent liability, you will disclose. Okay? Disclose. You get. You will disclose in your sorry. When your lawyer says for content liability that Mr. Opele, you are not going to win this case, so you will disclose and make provision when it is below 50%. But however, when your lawyer says that Mr. Opele, you are likely to win this case, so in that case, you are going to only disclose. You're not going to make provision in your account. Do you get? Because it is a possibility and not probability. Do you get? No, I'm talking about I'm asking you both asset and liability now. For a contingent asset, eh? Keep three things here. Let me just give you the handwriting exercise so you don't confuse all of you guys. Now, contingent assets. This is a shortcut. Assets. Contingent liability. Now, disclose. Do not disclose. Make provision. Possible. Probable. Okay, this should be clear like this. Okay, so okay, so now possibility contingent assets. Contingent asset is possible. Once it is possible, what do you do? Once it's possible, contingent asset, what do you do? Hold on. This will make it easy for you guys. So now, once it is contingent asset, if it's possible, what do you do? If it's possible, you don't. If it's possible, you don't disclose. Okay? And it is probable, you disclose. Okay? I forgot to add one. Virtually certain. Virtually certain, you disclose. And you recognize it, right? It's possible, yeah. It's possible, yeah, you disclose. You make provision, no. Probable, you disclose. You no. You make provision, yes. Is this clear? Do you guys understand all of this? Hmm? Do you get this? Hmm? Are you guys following, Mr. Opel? Are you following? Hmm? Do you understand what I've done here? Okay, do you understand what I've done there? Mr. Opel, do you understand what I've done there? Hmm? Do nothing. Yes. Do not discuss if it's possible. And do not disclose, do not make provision. Just disclose. Which means a 70% chance, or like a 50% plus chance of winning, right? Right? Hmm? So just disclose alone. So, but if you are virtually certain, like I explained, when you're virtually certain, I explained that maybe you have the deposit somewhere, you're sure that you get that money. Do what? Recognize it in your account. Close and recognize it in your account. Not a provision, but recognize it in your account. Okay. But if but yeah, if it's possible in contingent liability, is usually possibility, right? So if it is possible, if they say that it's possible, just disclose a loan, don't make provision because it is below 50%, right? Because it's less than 50%, okay? Hmm? So only disclose that you have a liability, do not do anything. But if it is what 50% plus chance of winning, disclose and also make of losing, sorry, of losing, of losing the case. Eh? Disclose and make provisions. Is that clear? If you go through this chat, I'll snap and put on the group so you can have it. You guys can have it. Is that clear? So I've said everything. So I said contingent asset is a possible asset from past events. Which one? Which one? Which one now? Okay, I'm moving on. So a possible asset from past events, like I said, a contingent asset. You are just saying under the project. Which one is the one you're talking about now? You're not answering. You are just muting every minute. Can you just answer with you ask your question clear before you mute yourself, please? You do nothing. That's what I mean. Yes. Yes. Don't disclose these contingent assets. In contingent assets, when it is possible that you are going to get the money, do nothing. Do not disclose. Do not make provision. If it's probable that you get the money, which is 50%, which is this is less than 50%, though, I meant, right? Do nothing. If it's 50% upward, disclose a loan that they are expecting fund from so and so in your account. But do not no, this one you're not going to this one, just ignore this. Then this make provision, you're not making provision, right? So which is virtually certain you're going to get the money. Of course, yes, you are disclosing and you're making provision. So yeah. So I'm just gonna say do nothing, right? Do something that will help you guys. Okay? That's what it means. So by that's that I've done. So, like I said, possible asset from past events, which is what contingent asset confirmed by future events. The rules do not recognize contingent assets. Disclose if only probable. Can you see? If you look at my Excel that I've done here, when it is probable, I said disclose. Can you see? Probable, disclose. Can you see? And do nothing else. Okay. But virtually certain, recognize what income, recognize the income, and then what disclose. Can you see it here? Recognize only when virtually certain. Can you see? Becomes an asset. Can you see it? Disclose in notes if probable, with discussion of the nature of asset, estimate of financial effect if possible. So it's very, very straightforward. Question for you, Adejoke. A company has filed a company has filed a lawsuit to recover £200,000. Lawyer says it is virtually certain to win. What would they do? Are you there? Are you there, please? You said well, I didn't hear you. Hello? I can hear you. Yes, you're going to do what? They're going to do what? Mr. Apele, can you help out, please? You recognize assets. Thank you very much. Recognize asset of 200,000 because it is probable. So recognize asset of 200,000. If only probable, just disclose. But because it says virtually certain, when you hear the word virtually certain, recognize the asset. So, like I said here, the same thing, recognize assets. I was referring to this side. Maybe I should do like this or recognize asset. Is that okay? Okay, that's fair. Yeah. Okay. So the next question. So for some reason, my answer is not going away from me. Okay. So example three. At the end, Delta Limited faces three issues. One, warranty claim expected £20,000, which means if they then the second one is lawsuit, 40% chance of losing the lawsuit of £50,000. So if they have 40% chance of losing the lawsuit, right? And the other one, legal claim in its favor, 80% chance of winning £10,000. Classify and state accounting treatment. So for the first one, which is a warranty claim, expected of £20,000, that warranty claim they will make what provision and what they recognize what a provision because they're expected to claim warranty no sorry warranty claims expected 20,000 which they are supposed to pay because an issue to them, right? The company faces those three issues, which means they're not receiving that money, right? They're supposed to pay. So the warranty claim is going to be what they're expected to pay, right? They're expected to pay to them because it's a claim. So therefore they're going to recognize what a provision is a what? Is a probable cost, right? Then the second one is a lawsuit of 40% chance of losing the lawsuit. What do they do there? For the lawsuit, what they do there is the answer is there's a contingent liability because they only have to disclose because they have 40% chance of losing that lawsuit, right? So they have 60% chance of wait oh 40% chance of losing the lawsuit and 50% chance of winning. No, I think this is wording issue. So lawsuit of 40% chance of losing the £50,000 and 60% chance of winning. That's a that should be disclosed and should make provision should be made. So that should be disclosed, right? Are we correct? Are we on point? Because if they have 40% chance of losing, not of winning, which means they have 60% chance of winning. Oh, yeah, yeah, yeah. Sorry. It's correct. Disclose a loan. Don't forget the contingent liability. Don't forget what I taught you. I said when there's a 40% chance, you remember, right? When there's a 40% chance of losing the case, which means you have 60% chance of winning that case. So you need to only disclose only. You don't recognize because it is a possible. Don't forget that what I said here. Hmm? Don't forget this. It is what? It is a possible obligation. Can you remember? A contingent liability, a possible obligation from past events, right? It is probable when it is more than 50%. Can you see? So because it is not more than 50% at this case, it is just what? It is 40% chance. Hello? Sorry, I don't know what I got thrown off. I don't know why. Yeah, I got thrown out. Y- Sorry, I got thrown out. Sorry. I got thrown out. Can you hear me now? Okay, I'm back in. So can you see my screen? Okay, all right. So now, because there's a 40% chance of losing that case, so therefore there's a 60% chance of winning. So when there's a 60% chance of winning the case, what do you do in the liability? You only disclose, right? Because you have more chance of winning. Don't forget this chart I mentioned. Why? Liability. Is there possibility of winning? Possibility of losing, sorry, of losing is what? Less than 50%, right? Eh? Where will it fall in here? Hmm? Possibility of losing is less than 50%, isn't it? You only disclose because it is less than 50%. Can you see? You only disclose. So, but it's more than 50%, then you disclose and recognize what a provision. So now, legal claim in its favor. Can you see? 80% chance of winning 10,000, £10,000, which means this one now they're likely to win £10,000 and 80% in their favor. However, we did not say it's virtually certain, right? So therefore, we will what? We recognize what? Only disclosure. We will not recognize any assets. Okay? Don't forget what I said in that Excel. I say only when it is virtually certain, right? I say 50% chance of winning the case, right? Right? You only disclose. But if it's virtually certain, I'll not put here virtually certain. Hmm? Certain. Then make what? Recognize assets, right? Eh? Okay. Are we good? Okay. Recognize what assets, right? Are we good? So that is it on that. So that's that. That's what we need to do on that. So the next one. So key takeaway from all of this is that when we have provisions, right? Provision is what? A present obligation, and then there's a probable outflow. There's a reliable estimate. Those three things must be there. There must be a present obligation that arises from past events. The obligation must be probable that there will be an outflow. Once it is probable that there will be an outflow, and then you can get the amount. If you cannot get the amount, then you cannot make provision in your account. And with provision, it becomes a contingent liability only when it is what? A possible obligation, not probable. Remember that word. If it is a possible obligation that is not probable, which means it is what? Less than 50%, then you don't recognize provision. You only what? You disclose. Right? Contingent asset is what? Possible inflow to the company. You only disclose. You don't recognize an asset only when it is what? Virtually certain that you recognize what? An asset. Then measurement. How do you measure? You measure based on best estimate, discount if material. Then disclosure, you what? Explain the movement, timing, and uncertainties. And that is all for provision.